I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Every year for the past 4 years, I've been lucky enough to be given time with Richard Brindle at the opening of the Monte Carlo Rendezvous. And every year, we've had the sort of conversation that helps set the tone for the rest of the gathering, and indeed the rest of the calendar year and into the next. This year was no exception. As ever, Richard was forceful, unambiguous and direct on everything from the state of the market and the growth opportunities within it to what the Fidelis Partnership has learned from its experience with the Russia-Ukraine Aviation War losses and the California wildfires. Richard was joined by John Paul O'Hare, the Fidelis Partnership's Group Director of Underwriting. As the discussion took flight and encompassed subjects as diverse as the application of AI to the insurance work ethic, service levels and the return to the office, John Paul held his own. As a result, I can highly recommend this episode for an original and uncompromising view on the opportunities and threats facing the global specialty insurance and reinsurance markets into 2026 and beyond. Enjoy the podcast. Richard and John Paul, welcome to the Voice of Insurance.
Thank you.
Thank you.
We're down here at Monte Carlo. It's a good time to talk about setting the scene for those renewals we come up in at the end of the year. The hardening phase of the market seems to have run its course. At the same time, most people are still talking about being able to grow or wanting to grow. What's your perspective? For one, do you want to grow? And if you did, where do you think you could and how would you do it?
Okay, well, I think the first thing is just to reiterate that we are now a risk allocator. We bifurcated the business at the beginning of 2023. The capital flowed to the Fidelis Insurance Group, quoted on the New York Stock Exchange. They're our sibling company and they're our best friends, but they're a different company. We originate business principally on their behalf, but we do also now have a Lloyd's syndicate and we have plans for further capital partnerships in the medium and near future. So we look at things slightly differently from a balance sheet, obviously. Growth for us, well, first I'd like to just gently push back on the contention that everything's going down. Another really important point to get across is we are an incredibly diversified organization now. We underwrite 148 lines of business, which is extraordinary, and we're very proud of it. And to be honest with you, Mark, a lot of those are, if you like, not headline-grabbing lines of business. People tend to focus endlessly on big aeroplanes and big ships and property risks and earthquakes and hurricanes, because that's kind of the DNA of this industry, and it's also the most attention-grabbing kind of sexy stuff in our industry. But there's lots of other business that doesn't necessarily hit the headlines, which is different pricing cycle. So our overall RPI, as we put it, our renewal price index for our portfolio year to date is 105. And there's many, many areas of our business. Bear in mind, we're going to transact well over $5.5 billion of premium this year. A lot of that premium, again, doesn't hit the headlines, but it's up 5, it's up 10. Added to which, because we are leading underwriters, we are thought leaders, we're price makers in everything we do. We lead over 95% of our business. We are commanding a differential certainly to certain sections of the market. As rates soften in certain areas, and we've seen this movie many times before, verticalization, i.e. different pricing for exactly the same risk, tends to come roaring back, as it were. And we're seeing that now. And we're seeing on many placements there's a spread of maybe 40 points from the best price to the lowest price, which is remarkable when you think about it, for exactly the same
percentage
risk.
points.
Percentage points.
That's enormous.
And we've seen it before. This isn't anything new. And we like to think that we position ourselves at the very top of that. So those are some ways in which we mitigate price reductions in certain areas of the portfolio. But the other big engine of growth for us is Pine Walk. So Pine Walk, as you know, is our MGA division. We have doubled the number of cells in the last year in Pine Walk to 16. When we first did the bifurcation, I confidently predicted, and I was a little bit optimistic about the amount of time it would take, that we would act as a magnet for talent in the industry. Clive Washburn is a well-known exemplar of this. Clive, fantastic market figure. We had a conversation in 2021, I think, about him coming across. And what Clive wanted to do was get back to underwriting, to dealing with brokers, which he's past master at, and away from what you might call the more bureaucratic side of life, particularly in public companies. We did a deal. We welcomed him in. He's gone on to write, I think, about $450 million of premium this year. It's one of the biggest marine insurers in the world. And then when you add them to what we do at the Fidelis Partnership, we're right up there in a kind of $700-800 million mark, which is huge in the marine world, possibly the biggest. And what was intoxicating to Clive was just not having to deal with what he would probably call admin and just get on with deal making and underwriting. And this is the Pine Walk story. And as time has gone on and we've proved out the business model, we've had more and more people coming to us to set up their own sales. And we're now up to 16, I think.
And that offer, it's not just that you're part of the Fidelis Partnership, but you're owning your own part of that partnership.
You are, but you're also part of something much bigger. So JP chairs a meeting we have on a Tuesday. I shouldn't give away all our secret sauce here, but he chairs a meeting on a Tuesday, which is attended by me, by him, by all our senior underwriters at the Fidelis Partnership, but also by all our Pine Walk cells. And I often describe my job as the joiner-up-in-chief. It's such a big organization now. We do so many things in so many countries through so many different platforms that you've got to be constantly thinking about joining up, about cross-selling, about cross-traveling. We've got people traveling at any one time to every corner of the world. It's very important when they do that, they have fact sheets which they can hand out detailing what we do, where, when, who does it, and joining up the dots. And we do that, I think, uniquely well, Mark. Indeed, a lot of the people who join us say, oh my God, this is so refreshing. We actually get to talk to our colleagues and join up the offering rather than being stuck in a silo. It's not for everybody because you've got to work bloody hard and you've got to be an entrepreneur. It's your business. We own the majority of the equity, but it's your business.
You do the work.
You do the work. And if you can't be bothered, then it ain't going to be a success. So it's a high bar, but I think every sale we've got into Pine Walk has been a roaring success. So that's quite a long answer to your question. That's how we achieve growth.
No, that's good. Within that 105, obviously there are going to be some that are in the 90s or 80s. Any that you single out to say, well, this is not as good as it used to be, want to be lightening up on?
I think for our portfolio, the way we look at it is some of the sub-components within those classes will be down. And then you have to think about the mix between what's new business that is loss impacted from those classes, which is positive. Those are the type of products and classes of business that Fidelis, because they are first in the queue to come to, because of the service levels that we offer and solutions that we're able to offer the clients, that we're able to get positive rating on those. So between splitting out what's pure renewal, some of that, yes, definitely risk adjusted off, but then counterbalancing the new business plus the new growth due to the travel, due to the cross-selling, cross-collaboration with all of our business units and Pine Walk is how we're able to get that overall 105 that Richard's mentioned.
Yep. The only other thing I'd just add to that, Mark, is it's also about how you access a given peril. So, for example, CalQuake, earlier on this year, some of the XOL renewals are pretty disappointing. So we pivoted to proportional writings where the original rates on homeowners business in California are still roaring up because of the wildfires. So it's sometimes a matter of not just the peril, but how you access it in the supply chain.
And in fact, we might as well put the wildfires to bed. Obviously, when I'm a journalist, every time there's a big loss, we always look and see how it's distributed, what happened, what we've learned from it. Was it what we expected? Was it priced for? Was it actually planned for? From an underwriting perspective, how did it pan out for you and what did you learn?
From our perspective, that loss was 4 times greater than any wildfire before. It was a huge market-changing event in terms of its size and is something that we would expect it to be of that size. So that's what insurance is for. It's for when those big events happen that you pay those claims. The thing around the underwriting side, lessons learned. Yes, we look at the underlying pricing. Yes, we look at the underlying aggregations. We have further developed all that just like we would do post any major event. And then there's the risk allocator model within TFP now. We get to look at that new risk and then we make sure we are charging appropriately and can take advantage of some of the rate changes that have come through post-loss on those programs.
Again, just add to that, we were going back to the sort of hard driving qualities we're so proud of at TFP, we were the first to go down and visit people like Mercury. Post-loss, in fact, we were the first. And they were enormously appreciative. And we helped guide their thoughts about how they go about renewing their reinsurance programs.
You look at Mercury's results over those quarters and you see, well, this is a fantastic advertisement for the reinsurance industry, for the global insurance industry. You're talking about a very large gross loss and a manageable net loss. And it's exactly what they would want to happen.
Indeed. And I should mention that the Fidelis Insurance Group were complemented by numerous partners on being one of the first markets to pay the claims. Sometimes claims can be opaque in our business, but sometimes they're just absolutely bang on, pay them as quickly as you can, allow your clients to rebuild their capital and move on.
The one thing about the wildfire loss, it was already on the map. It was absolutely on the map, but now it's going to be on every insurance regulators in all 50 states and everywhere else. If it wasn't on their map before, they didn't think it was a potential problem in their territory. Of course, we even had wildfires in Scotland this summer. Always, the unexpected seems to happen everywhere. Other losses, talking about more opaque ones, Probably now, given court judgments, it's a time to put the aviation war losses to bed. Again, you'll be able to tell me whether it's completely put to bed or not. Any learnings from there?
I think the question's about putting to bed for the Fidelis Insurance Group, but I will...
But actually from an underwriting perspective.
Yeah, lessons learned, sure. I will commend them for dealing with it very proactively, reserving early, reserving at scale, and, if you will, getting the bad news behind them. And I think they deserve a lot of credit for that. I think the major lessons to be learned here is all of us watched the build-up on the Ukrainian border and all told ourselves there's no way the Russians are going to invade. And we lulled ourselves into a collective sense of false composure and comfort. And we at the Fidelis Partnership will not be doing that again. We have all sorts of intelligence feeds now, and they are not confined to the sort of, dare I say, fairly cliched sort of UK-based ex-army officer type things. There's a place for those guys, but we have intelligence feeds from all over the world. We live in a multipolar world, and we have live intel from places like Beijing, Taipei, and obviously Taiwan, China is on people's minds. We would be very alive to any significant build-up or preparations for any sort of hostilities in the Taiwan Strait. We have also, on our aviation book, pretty much uniquely got onto 48 hours notice. It is pretty amazing to us, to be honest with you, Mark, that the market as a whole is still on 7 days. 7 days can be an eternity in a situation like that. It's a long time. So we're on 48 hours. We don't use those notices lightly. The airlines are our partners. And dare I say, we've written a lot of very, very profitable, indeed clean premium on both marine and aviation war since the Russian invasion. But certainly we would not be caught napping like that again.
Yeah, so it's really about being more nimble, being more ready, and really trying to imagine what could go wrong and where.
Absolutely. And this is a theme I did want to explore at the appropriate points today, Mark, because there's a good saying, which I think is very applicable to our industry. Success is 90% perspiration, 10% inspiration. Most of it's just showing up and working hard. The other saying I like is 90% of life is just showing up. And we showed that post-COVID when we were the first back into the office. We were the first company to be back to 5 days in the office. So we're very proud of that. We're in a business where we have to service our clients. And sadly, when the Sudanese civil war blew up, it started to unfold over a weekend. And our team was straight into the office on the Saturday to look at our exposures and take appropriate actions. That's what you have to do. We're in an events-driven business. The fact that our industry as a whole is operating Tuesday to Thursday and a bit on Monday and Friday, if you're lucky, and forget about the weekends, this is not good enough. It is not good enough. We had an example just last Friday where a broker called us and they had a shortfall on a construction risk in the Middle East, and they had to get cover by Saturday.
It was breaking ground. Huh?
Yeah. It was an immediate need. They had a shortfall. We were able to price it at a differential. And I was personally involved. So was our head of marine. So were our actuaries on a Friday night and a Saturday morning. And the brokers couldn't get hold of anybody else, Mark. And, I don't think this is talked about enough. I think that's disgraceful. We should be available. We are in an events-driven business. My past battles with Lloyds to get them to open up at the weekend and during the Gulf War are well known. But it carries on in many ways. I think it's worse post-COVID. People just aren't available. And I don't think that's good enough. And we do things very differently.
What about flows of business? Obviously, spoken about the price of business and the rate adequacy of that business. What about the flows? There was changing, ebbing and flowing, operating mostly in the specialty, in the excess and surplus world, in London and Bermuda. How are those flows holding up? Obviously, as that cycle often changes, and we know that there is inflows and outflows between the admitted and the excess and surplus lines market. How's submission flow holding up?
Our submission flow has been incredible. In 2024, it grew 23% to nearly 17,000 submissions. And obviously at TFP, our ability to offer a meaningful line size across placements means that we might typically have lower submission numbers than others. But here, 17,000. And as at September this year, we're already at that number. So we can expect another 20-25% this year.
So whatever the market's doing, it's certainly not turning in on itself and it's still facing towards you and asking for your opinion.
Exactly. And to the point Richard made earlier on around how we host these meetings, how we're all joined up across the different Pine Walk cells, how we're now up to 16 different cells across over 140 classes of business, means that that's a real big driver for continued seeing everything and being in top three in everything that we do and really growing that submission volume.
What about the reinsurance market? I don't know if that's more of a question I would ask to the other side of the balance sheet, but as an underwriter of reinsurance, what's the market like at the moment?
Again, we're not a market tracker, Mark. We lead the vast majority of our business. We travel a lot. Funny enough, we were just running through as a team last night the number of meetings we have at the Rendezvous. We have 180 meetings. Of those, probably no more than half are traditional cat reinsurance meetings, probably more like a third. Most of them are multi-class meetings with carriers who, interestingly, have gone from viewing us as competition to a source of business, because we are that rather unique thing now on the insurance spectrum, the value chain, of being a risk allocator. So we are actually not competing with many of the big names who are down here in Monte Carlo. We are, in many cases, a prized source of distribution, because we do originate business that others don't, from parts of the world that others don't. And we have, again, that diversification across all those asset classes. So it's not just about reinsurance here, but I do think our reinsurance account is something we're very proud of, and we think it's really quite differentiated. We'll write over $1 billion this year for our various capital partners, mainly the insurance group. We have a shared concern about climate change and frequency, so we are positioning our exposures at a level where they're only going to be paying out if there's something big, which will mean we get a lot of recoveries, but also would expect to see meaningful market change. So I like where we're positioned, and I don't regard us as being writing a kind of typical reinsurance account.
Yeah, and I suppose it's not right for me to be asking you as a buyer of reinsurance. That's not your job anymore, is it?
Well, it is actually. It's one of our delegated functions under the agreement we have with the insurance group is to go out and buy reinsurance for them. I mean, it's a very collaborative process. Danny Burrows has obviously a lot of experience in that world, and he's got some strong contacts and strong views. But we do lead that function for our various and
because you're market traders, you really know.
Yeah, for our Lloyd's partners, we buy all the reinsurance for Lloyd's, but in close collaboration with the IG.
Yeah, and as a buyer, how those conversations, particularly with alternative markets, those ILS markets, when we've had previous conversations down here at Monte Carlo, maybe 3 or 4 years ago, you'd say then the market was shut then. What's it like now?
I would say the ILS is much less of a force than they were in the past. I think they struggle to reload. I don't think many of them have anything convincing or plausible to say about climate change. And we still have this absurdity of these pricing models, which are stuck in the 20th century. So nothing's changed. We see
so more historical pricing.
We see you every year, Mark, and nothing seems to change. That does explain why there's just no new capital coming, apart from retained earnings. There's no new capital.
Yeah, I was going to say that growth that we'd seen, the nominal growth in the ILS, seems to be mostly retained earnings rather than new money.
Absolutely.
Yeah. And actually, on the question of frequency, when you're talking to buyers, it's one of the talking points probably down here at Monte Carlo is if the market has changed ever so slightly. We had the reset 3 years ago where all reinsurers were able to move away from attritional loss completely and reset attachment points so that did not reoccur. Under what circumstances might you be able to consider writing frequency? Only when it's incredibly rare amount of frequency. Say if we have an average of 10, if you wrote in excess of 15, then you'd say maybe. I don't know. I wouldn't want to put words in your mouth.
For me, it's when you can comfortably price for it. So if you've got comfort in the underlying client, underlying portfolio, if you're comfortable with your overall exposure in a given region territory, and if you can structure a deal that works for both you and the client, then you can come to something that might work.
Yes, so back to sort of there is no such thing as a bad risk. It's a bad structure and bad premium.
Yeah, I mean, there's a price for everything. I've always said that. But also bear in mind, Mark, now we represent multiple capital platforms. They have slightly different risk appetites and reporting cadences. So, for example, Lloyd's reports annually, whereas the insurance group reports quarterly. I don't think Danny Burrows wants to be talking about a cloudburst in Copenhagen or a snowstorm in Slovenia in his quarterly earnings calls. And I don't blame him, because it just attracts a ridiculous amount of attention. You spend weeks dealing with all the questions, and so what? Whereas Lloyd's reporting annually has more tolerance for those. So again, what we're able to do is shape our offerings such that we fill, if you like, the risk buckets of each capital partner, but the holistic offering is very attractive to the client because they can have some frequency cover via Lloyd's, have severity cover via the insurance group and stuff in between from both. It's all dealt with by the same underwriters. And as an overall package, it's very attractive to them.
Forever, in the aviation market, people have always had deductible buybacks, haven't they? But it's not something that everybody wants to write, or is it necessarily very efficient to write? Well, maybe, I don't know, now with higher interest rates, is there a bucket? And that there's less friction, perhaps with a more digitized market, with just less frictional costs. Might there be more appetite for what we used to call money swapping? Particularly if you're earning 5% on cash, it's not bad.
Yeah, we just go back to my previous point. I think there will be some things that we look at and say that just doesn't work. We aren't in it for cash swapping. If you can construct a portfolio and you can have certain deals that will run at typically a higher loss ratio but are less volatile and fit the overall performance and portfolio returns for that capacity, then yes. But something for money swapping, I would say no.
What would you say if we're in an interesting position with lots of retained earnings? And I would guess where you are philosophically on this. When you have excess capital, what should you do with it? Generally, I presume you'd say you should give it back.
We're not a balance sheet, Mark, so
no, I know.
It's not really a question for us.
No, but you're just an opinion.
As an opinion,
what do you
as a
wish
third
people
party.
with balance sheets would do with their excess cash?
Well, I think they should return it. I mean, when I was running Lancashire, we pioneered the concept of the special dividend, and it was enormously popular with shareholders and has since been widely adopted by others. And the premise of that was, if you've got excess capital and nothing to do with it, give it back. I'd like to see more of that.
You're a leader in everything you do, and that's what you just said. Other leaders are now pioneering a new form of underwriting. It's not necessarily new. I mean, it's been around forever. I mean, it's like writing a proportional treaty, portfolio underwriting, tracker underwriting, more capital-focused underwriting, using better data than we used to have and perhaps more technology. That's something that seems to be becoming part of the toolkit. Is it a part of the toolkit that you're just saying, I'm not interested in, when we're looking at automatic, semi-automatic, algorithmic, whatever you want to call it? And there are so many different flavors of the same thing. Broker facilities, things that are certainly on the face of it are becoming much more sophisticated. You can get in the weeds and you can get your technologists really in the weeds on these things. And if you can get the data, would you consider something that could be a good write?
Not really.
It's just a risk. I mean, it's another risk like any other.
Yeah, but it's a risk paying less premium with higher commissions.
That's fair enough.
That is the bottom line. You're getting less money than last year and you're paying higher commissions. However much you dress it up with all the algorithms and the tech and you got half a point, Mark. There is a greater ability to slice and dice what you participate in. It's not just a binary thing. Do we write the Aon or the Marsh global full follow facility? It's more sophisticated now. I accept that. But still, the fundamentals is you're taking risks, you're reducing the premium, and you're adding additional commission. And that's not what we want to do.
And I suppose if you're already underwriting 145 classes, you've already got diversification. So you don't need diversification in that sense. That, if you were monoline, you could say, well, it makes sense. I'm mono. I'm only one or two or three lines I'm really good at. And then I can then decrease my cost of capital by writing this in this way. It might make sense. But then you're not a balance sheet business, so you don't have to worry about that.
Indeed. I think it's about relevance. We get back to our leadership stats and a multiplicity of our lines of business and our sheer hard work and availability. We like to think we are incredibly relevant and helpful to brokers. And I think they would all admit that. Sometimes they don't like our price. Sometimes they find us a little bit hard driving in terms of demanding the right allocations, the right signings on risks. But at least we're there. I've never been a broker, but I think if I were a broker, what I would want is an answer, not a bunch of out-of-office emails coming back. And we're there when it matters. And JP made an interesting point earlier in the context of AI. It's hard to see how AI replicates that Friday night call when everybody else has switched off their phones.
Well, I suppose at least AI is on.
Yeah.
It's on. So if it can answer that question, i.e. the computer can give you an answer.
At least it's on, rather than being on out of office.
It probably won't give you an intelligible answer, which is the main problem, I would assume. You already mentioned about the dynamics of the market in a digitized world. These dynamics of the market, obviously, in aviation have always been this case, this verticalization. We're starting to see that, and it seems that the digitized world with less friction or zero friction is starting to bring this back to the fore. What do you think the dynamics of the fully digitized market? You already mentioned about verticalization of pricing and having leader and then leader minus X for everybody else. Do you think we're going to see much more of that?
I would love if you could have better data quality, you could have more standardized flow of submission information. If the AI could improve workflows so that you get deals to the underwriter's desk quicker. But I don't feel it's there yet in our industry in particular, where it can make those decisions. Where a client has a problem, you want to have an innovative solution, you need some new wordings, something that needs tailored to the client. The AI digital process isn't there yet. And I don't think it can answer a phone call. I don't think it can develop that relationship when you go visit a client. So as much as it's great to see it developing, it's great to see these digitalization in the industry both progressing, I think it's a long, long way from where we'd all like to see it.
Yes, it's not going to start getting in the weeds about your claims control versus your claims cooperation clause and the actual wording, what that clause actually says and the difference between one and the other.
Exactly, or changing it post-loss where you're looking at radius clauses for a wildfire event and how it should interact. It's going to take something off a shelf and propose it, and an underwriter might just say yes without really reading or understanding it.
Yes, again, so we can all trade shares of BP because they're all identical to each other, and this is not quite the same, and it's never quite the same, and it's always been the case. And again, reinsurance has to be back to back on the original, and that's not always the case either, and of course, that's often deliberately not the case. What about AI? We couldn't be sitting in 2025 and not talk about AI. And I know in previous conversations, Rich, we've had conversations about technology and you having that foresight of embedding the technologists with your underwriters so that they actually all talk to each other. How's it been going in terms of experimenting with AI and finding out what it's good at? And so have you had any good experiments that you think, great, we're going to carry on doing these because they've been incredibly productive?
It's great at getting better. It's not there yet, but it's great at getting better at cleansing information coming in from submissions. So the specialty market in particular is less structured. It's getting better at cleansing that information and being able to pass it through a pricing model, pass it through wordings to get it to an underwriter. So that's where I mentioned earlier. I think that is something that is getting better, and that's where we're really pushing it. It's on the submission flow to get that through as quick as possible, get it modeled, priced as quick as possible, and get it in front of an underwriter.
So it's the classic thing where it's the broker's email's got a PDF and 2 spreadsheets attached to it.
Exactly. We can read through the PDF. You can extract information from the spreadsheets. You can throw that through and then have an underwriter have a look at proposed pricing.
So that's been the moment where you can say, right, this is really useful. This is increasing productivity and means we can get back to that broker much quicker.
But the problem is the quality of the data coming from the broker. So we had a risk last week in Myanmar where there was just no information from the broker about all of the issues in Myanmar. Sadly, there's a civil war going on. There's sanctions. It's complicated stuff. There's sanctioned individuals. There was no information. So AI can only go so far. Sometimes we just have to go and do it ourselves. And in that case, we found ourselves doing the work ourselves.
Yeah, back to the old bespoke, roll up the sleeves, get the intel.
Yeah.
I think AI will be years away from being able to deal with that level of complexity on a lot of our portfolio.
What about new risks, any of the new classes of business that seem to be emerging with carbon credit risk? I was even talking to someone recently about the scaling up of nuclear fusion. There's an awful lot of things going on. And of course, just good old renewables are still new and still, of course, scaling up massively. Any of those more nascent classes of business that you're particularly excited about and pleased that you're getting involved in?
A good example of that is Novagen, is a pine walk cell we started in Q4 last year, focusing on renewables. So that's a growing space. In terms of fusion and carbon, I think we're always looking at new products to see how we can be innovative and create something that becomes a product. The difficulty is always data. So it's how do you know what you're covering, how you're structuring the wordings, and how do you know that the price will be acceptable to provide profitable business for the capacity. So definitely interested in all of those things, but the stumbling block will always be, can you get to something that is a viable product? A great example of something that we did back early 2016, 2017 was related to aviation financing. That is something that we developed the product for, created the wording, got comfortable around the pricing, and we have a pine walk cell called Itasca, which is really the market leading go-to place for that business. So that's a case where we have done it, and it's showing that's something that TFP is always pushing to do.
Yeah. The innovation problem, of course, is the classic broker goes to underwriter and the underwriter says, where's the 10-year loss record? And you go, well, there isn't one because it's nuclear fusion. It hasn't happened yet. And it's, can you help me pioneer this thing? Maybe I could do a 1% net line. But I've certainly spoken to some people to say that this is where AI may be very useful, to create a synthetic loss record where none exists because it's forward-looking. And also, in a lot of those industries, they're using AI to design those products. For example, to build a satellite. They're using a lot of that technology, i.e. the product itself, the thing I'm being asked to ensure, has been designed in a much more intelligent way, so therefore I could be more comfortable with it. Do you think that might be a good use of AI in the future in terms of innovation?
Yes, where AI has models that can churn through thousands and thousands and thousands of pages of theses from PhDs and all sorts of academia, then that will be a very powerful tool to, I guess, just crunch numbers faster, crunch analysis faster to help understand what if, what should the price be, what could the claims historical experience be, even if you don't have any.
Getting near to the end of my questions, we mentioned about the syndicate. Haven't had an update on how's that going. The Lloyd's syndicate, sounds like you're very happy.
Very happy and very, very impressed by the Lloyd's management team. I think from Patrick down, Rachel, Dawn, all the people we deal with, been absolutely first class. What did they want from us? They wanted Lloyd's to fight back. The Lloyd's I grew up in was a lead market in pretty much everything we did, with a 40, 50, 60, 70% market share. Now often Lloyd's has got a single-digit market share and has been a following market for years. And Lloyd's rightly want to turn that around. One of the things that we've really noticed with our clientele is the Lloyd's brand still has huge appeal all over the world. And that's enabled us to increase shares, to take even more strong leadership positions on a whole range of business across our portfolio. Lloyd's wanted underwriting discipline, and I talked to those guys a lot about that. It's terribly important, particularly now that there are signs of ill discipline. And believe me, we see some stupid stuff, Mark. I mean, some epically stupid stuff. We saw a risk last week in Puerto Rico, which was being priced with no exclusion for a weather system, which is now dissipated, but as of Wednesday, Thursday last week, was looking like it would turn into a full-on hurricane, and people were writing this risk with no exclusion for the current weather system. Unbelievable, highly irresponsible. Lloyd's quite rightly wants to see an end to that sort of ill discipline, and I do think I've got a well-earned reputation for strong underwriting discipline now, but they want thought leadership, they want price making, and we've delivered on all of that. And they in turn have been very flexible about our growth plans. And it's a terrific partnership. And I'd also like to mention Hamden's. We won an award last week. It's normally the absolute kiss of death when you win an industry award. But we won an award for Partnership of the Year between Fidelis Partnership and Hamden's. They've been amazing. You know, I think the names capital had been patronized and marginalized quite unfairly. It's an extraordinary source of capital. Very loyal, very knowledgeable about what we do. And we were delighted to pioneer, I think, the first exclusively named syndicate for decades, certainly at any sort of scale. And Hamden's have grown with us, as have the other members agents on the syndicate, and it's been a terrific three-way collaboration.
But you mentioned right at the beginning about potential new capital partnerships. Again, anything you can say so far?
We have got conversations underway, not quite able to talk about it yet, but we hope to have much more to say very soon. And again, it's all in pursuit of this holy grail, Mark, and we're rapidly advancing towards that holy grail of the multi-platform risk allocator. Yes, the insurance group is our sibling company. They're literally on the 43rd floor. We're on the 42nd floor of 22 Bishopsgate. We talk all the time. And they are our main capital partner and probably always will be. But there are others because we have a very clear binding authority with the insurance group, which is very clear about what's in scope and what's out of scope. And that's often around credit ratings, around counterparty limits, about risk appetite. But there's also softer conversations around how much of this risk do you want. So we talk all the time. I'm proud of the fact that we provide a level of information to the insurance group which is quite unparalleled in the market. I mean, you look at a lot of these MGAs, and it's a quarterly border if you're lucky, and the detail is scratchy to non-existent. We're in daily contact, and I think that's extraordinary. Sometimes it's a little bit overwhelming, but it's an extraordinary relationship and it's unique.
You don't want someone second guessing you. If they've got a live feed of everything you're doing, it could be
no, we do
disconcerting.
We do the underwriting, that's clear. But we're incredibly transparent and we're proud of that. Again, it goes back to Pinewalk. Why do people want to come and join Pinewalk? Well, alongside all the other attractions, we have 10-year rolling paper from the insurance group, and we have names capital at Lloyd's, which is just about as sticky as it gets, versus, as you know, a lot of these MGAs where they have annual capital. That's an annual sword of Damocles. If that sword falls, it's over.
My last question would be going back into this real world, this complicated world, and increasingly more complicated and multipolar world. I was just wondering what your first thoughts have been on the effects for insurance and reinsurance of the imposition of tariffs on trade with the US.
It's been, I would say, I wouldn't say minimal, but we've been able to handle it pretty comfortably. We have a lot of American clients and brokers that we value massively. And many of those relationships go back decades, and we will always be very loyal to them. We're out in force at the WISIA conference next week. I think one of the biggest delegations of any underwriting organization. And that's a sign of how much we value those clients. We are very close to our retailers in America, like Alliant, who control vast swathes of municipal business in America. We know these guys personally. We never run a home run around the wholesalers. They're obviously very important too, but we know our retailers. I always say to the underwriters, know who your retailer is, because ultimately those are the guys who control the business. But we live in a multipolar world, as you rightly say. So the meeting in Tianjin last week was striking in the sense that, leaving aside your political views, there was probably over 40% of global GDP in that room.
Yeah.
And our industry as a whole does a terrible job of trading outside of North America, Western Europe, Japan and Australasia. Shocking. We think on average in our world, it's probably about 5% of premium versus 40% of global GDP. That's not good enough. We're already at about 15, 16%, I'd say. And I want to get that up to 25, 30% within the next 3 years. So Charlie Mathias, my deputy chairman, is in charge of what we call our BRICS Plus initiative. Obviously, the R is moot because they're sanctions, but Brazil, India, China, huge economies. And there's all the countries that have since joined. And we're constantly traveling. We're constantly looking at distribution channels and to see how we can do better. And that's another key source of growth for us, Mark.
But in terms of those tariffs on the US market, obviously the importer pays. Just sounds like it's just something you have to feed into your loss assumptions because, rebuilding a US property is going to, on the face of it, cost more than it did before.
Exactly right. And that's the exact sort of work that we conducted as soon as all of those different mechanics that you mentioned. Cost of claims going up, cost of timber going up, cost of claims going up because of delays, impact on BI, all of those elements.
But in terms of, I suppose, you're working to make sure that from a Fidelis Partnership point of view, you're going to capture your share of that world trade that is happening without relation to the US.
Absolutely.
It's been really good talking to you. Thanks so much for taking up some time at Monte Carlo. It only remains for me to say thank you so much, and hopefully we'll book in the time to do this all again next year. But thank you so much.
Very welcome.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.